We're going to start off with the question of the day here, Hayden. Now, this is it. How far can this Treasury rally go? We've seen yields, 4.24% in October, toward the end of October. We're yielding 3.52%, so that shows you how far that rally has gone. Are we done? Oh, I mean, you look at that jobs report and you think to yourself, well, surely that they're pricing in something quite different.
Yeah, well, the market's, the yield curve's inverted right now, so about 79 basis points. Whether you look from the front end to the 2s to 10s, deeply inverted, telling you that fixed income markets are telling there's a recession coming, and the Fed is once again overdoing it by hiking. But when you looked into that jobs report, you'd probably say they're still going to continue on hiking here. If you get into the wages number in particular, on a month-on-month basis, 3-month-on-3-month basis, it's up around about 8.5%. So really strong wage growth still going on, but maybe those job openings are starting to slow down now, or maybe they start to slide.
But there was some elements of the household report within that which would perhaps lend some support to your thesis there. But you look at what they're doing, you've got a very strong labour market, you've got high inflation, perhaps they're seeing that perhaps coming off a little bit. Have you ever known that to be the case in a developed market?
Well, look, I think all the forward-looking indicators are telling us activity globally is slowing down. That tends to have less of a reaction on the US up front. It tends to be more back-ended, but you're getting more of those internationally aligned firms like the Apples of the world and talking about starting to take job numbers back, so more of that tech industry. So I think now that the risk is that the US is going to get dragged down with what's happening in Europe. At the moment, Asia is still going really, really slow. We're waiting for that China reopening, but that's probably not until at least second quarter of next year.
But we're still seeing it. I mean, we're seeing the effect of that on the markets right now and what they're pricing in. Are they getting also a little bit perhaps ahead of themselves?
Well, we've been running ahead of ourselves all year in Asia, in particular around China, trying to grab onto that upturn and the uptick in the market here. I think this time it's got some concrete evidence around it. We've got central bank governors are out now, governors, we've got banks lending into the markets. All the supportive measures we've been looking for across China in particular are in place now. So we've got, coming into next year, I think we're going to pick up when infrastructure can actually start to happen. And then we'll get the sales activities coming through on the property side as well.
Hayden, David here. How then would you trade the 10-year in China, which is now, I think, pushing back towards highs? I think we're at 2.91, 2.92%. Obviously, that's backed up because of the reopening plan. Wondering how much further you think that's going to go, if at all.
Yeah, look, I think the trade of 2022 was to be short the US and long China, clearly, and now I think you want to flip that into a reverse. So we're underweighting. We think that the 10 years in China can get up towards that 3% as its first stopping point, and I think you want to be long against the US now. So you've got some very different trends in place and probably the complete reverse of what we saw last year. And this also makes sense, right? Because China is very counter-cyclical to what you see with the rest of the world. This time it's just been a little bit slower on its counter-cyclicality.
Okay, so as I guess a follow-up question there would be, as they reopen, I would imagine the risk premium fades ever so slightly too, and that might open up more options in the fixed income space in China for investors that probably don't have a lot of risk appetite. Are there any options that are now on the table for those investors?
Well, look, property at the moment is the one that's on the tear, absolute tear. So I think, if you're looking at property now, in the last month, we're up about 123%. That's in fixed income, by the way. But it's still down around just under 50% year to date. So it's still got a lot further to rally, I think, in that part. What we're seeing now is support measures coming from the bank sector, but what we haven't seen yet is actually the sales activity pick up yet. So that's still got some time to run. Look, onshore at the moment, I think it's been about short rates. Still, overall, it's got some great diversification characteristics. And if you're on a fully hedged basis, you've probably got about another 150 basis points, 200 basis points pickup to the US. So you're getting some fantastic carry there coming through.
So that's carry. What about for income? And let's broaden it out again for the region. Everything under your remit. Where do you think income investors should look right now?
Well, it's those high yielders. Look, Asia is behaving very, very differently to the rest of the world. So if we looked at the inflation block, it's somewhere between 2 to 7. The rest of the world has been in this, in developed markets 5 to 10, or emerging markets 5 to 5,000%, pick your number. And I think one of the reasons for this is all the trade deals that have been going on this year. So we've been cutting tariffs all year in Asia. So people aren't picking up on that yet. And I think that has a dampening effect on the inflation here. Lots of stability. So you start to look at Indonesia, you look at India, and I think those, even Korea at this point, it's done in its hiking cycle now, and I think you can start to leg back into those bond markets. And we like Australia as well in that context as well. We think they're getting closer and closer to the end of their final hikes.
Hayden, but dollar or local currency denominated? That's the thing here
I
as well.
still think dollar is the king at the moment. That's the key of everything.
I think you're probably finding yourself in a minority now gradually.
Spot on. So I think at the moment the contrarian trade right now is to be long the dollar again. We've had a nice pullback here. We've cleaned out all of those long dollar positions that have been in all year. And I think now we can start to see the US dollar go up again. We're going to get further hikes. And if we are going into recession, which the yield curve's predicting we're going into recession, then I still want to be long the US dollar when the rest of the world is suffering.
So you go in with dollar-denominated debt. What about some of those companies which have slipped from IG into perhaps just the upper echelon of high yield? Do they present an opportunity here?
Yeah, I think at the moment it's still going to be IG, and it's still going to be very, very short-dated IG in that sort of 1 to 5 year part of the yield curve, and not much beyond that. So IG at the moment and high yield later on once we see the eyes of the recession.